Only 39% of Americans say they could cover a $1,000 emergency expense using money that they've saved up. And a third of Americans earning over $150,000 say that they're living paycheck to paycheck, and many rely on credit cards to close the gap. Americans now owe over $1 trillion in credit card debt, a number that has doubled from just a decade ago. Meanwhile, we've seen the money that Americans put aside every year relative to their income come down to pretty much 0%. In the 1960s, people were saving over 10% of their income every single year to withstand a future rainy day. That was also the case in the 1940s and 1950s, right after the Great Depression and World War II, which you could say put people into a mindset where they spent less than they earned. Today, we actually see this figure slightly negative. People are actually spending more money than they earn in the United States every year. So we have a deadly combination of Americans spending more than they earn and also taking on a record amount of credit card debt. But believe it or not, credit card debt is just a drop in the bucket when you look at the total debt that Americans owe today. Total U.S. consumer debt currently sits at a staggering $17 trillion in 2023. That's around $5 trillion more than right before the global financial crisis. And that takes everything into account from student loans, auto loans, mortgages. In fact, mortgages make up the vast majority of U.S. consumer debt. So that's the debt that people take on to buy homes, and it was one of the large driving factors behind the global financial crisis in 2008, the housing crash. There was an extreme sense of euphoria around the housing market in the early 2000s. People took on extreme amounts of debt that they just wouldn't be able to repay unless the price of their home continued to appreciate. You can call that a full-fledged housing bubble if you want, but that isn't the story we have today. Americans have nowhere as much mortgage debt as they did back in 2008. Mortgage debt has come down substantially relative to the total household debt that Americans have. And yet people still feel poorer today than they felt in 2008. The Housing Affordability Index is at a lower level than we saw in 2007 at the very top of the housing bubble. That's a survey that measures how capable people are to buy a home, and you can see it's at the lowest level since the survey began in the 1980s. Now, of course, part of this is simply due to the fact that home prices have gone up massively, so people are less able to afford a home now that prices have almost doubled since 2012. And part of it is also due to the fact that mortgage rates are now at the highest level in over 20 years, making it extremely expensive for people to buy homes today. But those are not the only reasons that people are struggling to make ends meet today. People are burning through their savings. Throughout the last couple of years, we've seen Americans burn through pretty much all of the money that they saved up during the pandemic. You can see this bump in savings right here was during COVID, where nobody was buying anything, everybody was stuck at home, and you also had the government send paychecks to people. You had many people save up a lot of money throughout that period, but all of those savings are pretty much now gone. The personal savings rate in the United States is at a level that's only comparable to the period leading up to the global financial crisis in 2008. And again, if we zoom out to the 1960s and 70s, the savings rate was significantly above 10%. We've seen this massive trend since then where it seems people are struggling more and more to put money on the side for a rainy day. So Americans aren't necessarily suffocating from debt today. When you look at debt payments that people have to make relative to their income, that's actually at a relatively low level by historical standards. And it's why we see so many economists feel actually very optimistic about the future of the economy today. Because what that chart means is that people's salaries are actually quite high compared to the debt payments that they need to be making every month. So that means right now people are under a lot less pressure to pay back their debt because they're earning enough money. And at the same time, we're seeing the largest accumulation in credit card debt of the last 2 decades. This is the annual change in credit card debt. Last year, we saw credit card debt in the United States rise by over 20%. That's the largest increase in credit card debt accumulation since 2000. And in 2023, it's still rising at 10%. And that is with the highest interest rates on credit card debt that we've ever seen. Credit card debt interest rates are now at 21% in 2023. That's the highest level ever. And for comparison, in 2014, credit card interest rates were at 12%. So it's almost 2 times more expensive today to have credit card debt than it was 10 years ago. And we see the results of that in credit card delinquencies. So the number of people that are defaulting on credit card debt substantially over the past couple of years. Now, of course, it is still at very low levels relative to what we've seen in history. For example, during the global financial crisis, the rate of default that we saw on credit card debt was at around 6%, but we could see that shift very quickly over the next year. If we look at how quickly delinquencies are rising, credit card delinquencies are rising at the fastest pace ever. In 2023, they've risen by 50% from just a year ago. That's much quicker than what we saw during the global financial crisis. So while credit card delinquencies are still quite low, the situation seems to be turning around very quickly. And credit card debt today is triple the size that it was in 2008. We've seen a radical shift in consumer behavior since then. You can now just tap your card to pay using credit. You can even just tap your phone to make a credit card transaction. Just the size of the buy now, pay later market has grown from $1 billion to $6 billion over the last 3 years in this new exponential age of credit card usage. So while the total size of credit card debt actually only makes up 5% of the total debt that Americans owe, it's really the behavior of consumers today that is worrying. People are saving a smaller and smaller portion of their income for a rainy day, while spending more and more using credit card debt. What happens if there's an economic recession? The probability of a recession today is at around 60% according to the yield curve, which has a perfect track record at timing recessions. Can Americans withstand a recession with virtually no savings and an increasing amount of credit card debt? Probably not. Similar to what we saw during the pandemic, where the United States government had to run a massive deficit to compensate for the lack of savings that Americans have. If we see another recession, the government would likely need to print more money, run a larger deficit to compensate for the next recession. We've seen government deficit deepening over the last 20 years, and unfortunately, we don't see that trend reversing anytime soon, and we think this is going to trigger tidal shifts in the economy and financial markets.